Let's take a look at some information and charts on Balancer for BraveNewCoin. Balancer is an AMM DEX with a twist in that you can set variable percentages and numerous assets in the quote-unquote portfolio that generate yield and rebalance automatically. The token has a protocol revenue, supply side revenue aspect to it as well. And ideally, this shifts, similar to the Yearn vaults, this shifts people into automated passive strategies with low fees, so long as Balancer can move more towards Arbitrum, Layer 2, potentially other stuff like Polygon, bridging, and allow this type of trading to thrive. Because if ETH fees are high, all of DeFi generally doesn't do so well because nobody can use it. And if nobody can use it, then the use case for all this stuff just doesn't even matter. And just like the other DEXs, they have full interoperability with MetaMask and various other wallets. And like I already said, they're on Polygon and Arbitrum, probably adding more eventually if I had to guess. This is what the pools look like, similar to Curve, where you can get like assets on different variability in the same pool. So Wrapped BTC, Ren BTC, Synthetic BTC. You can have Val ETH, 80-20 here they have. You can have all sorts of crazy stuff, right? It doesn't have to be 50-50. Now, the impermanent loss is perhaps harder to calculate, but how impermanent loss works is if volatility between the two assets is high, impermanent loss is also high. Ideally, over time, this balances itself out. Near-term impermanent loss is usually its highest, and as things equalize over time, ideally, again, not perfect, not a great system, but over time, this stuff generally works itself out, and you can calculate this. There are websites to do this. Let's say you want to throw something into a 60-40 ETH DAI pool. You can plug that into the calculation, look at backtesting, look at what your impermanent loss would be, and then compare that to the rewards, the swap fees. They also have liquidity mining, which incentivizes people to throw funds in certain places, at least for a short period of time, as long as the liquidity mining is there. The question becomes then, does this still give you an ROI beyond impermanent loss? As somebody in a pool, you want an asset to be somewhat volatile, but flat over time. So let's say ETH versus DAI has crazy volatility over the next 2 months, but the endpoint price between now and 2 months from now is the same, right? That would nullify impermanent loss. It would encourage trading activity and swap fees, and it would allow you to create the highest ROI potential in this pool, right? And you'd have to calculate that and gamify that and look where most of the volume is here on a balancer, compare this to other pools, look at all the APYs, right? And you can have that thought experiment with yourself to think about where the best place is to put something. But it's all here to look at. It's all connectable to everything, should you be so interested. If we look at the DEX volume amongst all the DEXs per day, in the last 24 hours, in general, Balancer doesn't get, it's this turquoise slice here, doesn't get too much volume on any given day relative to the giants, UniSushi, Curve. And on a monthly basis, in the gray at the bottom, not very much volume either. So it's early days for Balancer, but as long as they can go multi-chain, continue to innovate, continue to add features for people, outcompete other DEXs and AMMs like Bancor, then I think there's a draw for them there competitively. If you look at the TVL across the 3 chains, most of it is on Ethereum. Total TVL basically at an all-time high here in USD terms, which is certainly bullish for the protocol. TVL isn't necessarily always impactful for the token itself. It's just a general sentiment stamp, seal of approval, I guess, on the token. On Ethereum, trading volumes have picked up. Transactions and users have briefly picked up in a large way. This is probably liquidity mining incentives in a short period of time. Came and went. This was also a high volatility period in price action. So that plays a factor in these DEXs as well. But it's not bullish to see all of that volume and users just disappear right after the incentives are gone. On Arbitrum, very little users and interaction, still early days there. And on Polygon, TVL waning a bit, volume still flat, transactions rising, users slowly rising, right? It's still early days. Not only is it early days for most of this DeFi stuff, but it's definitely early days for layer 2 scaling, bridging, super early. We'll see what wins out at the end of the day. My guess is the cheapest version of whatever will win out at the end of the day. And if you're curious how much cheaper layer 2 is, you can look at this website, layer2fees.info, and you can see the stuff listed here. It doesn't list all the bridging. It doesn't necessarily tell you need to hold this for a certain amount of days in a roll up or whatever. I forget the distinction between the two, but one of these, Arbitrum or Optimism, has to be held in the pool for a certain amount of days. Don't quote me on that exactly, but the point is there's a lag time between getting it on and off either Arbitrum or Optimism, whereas bridging is potentially more advantageous for trading. It's quicker, but there's security issues there. So there's always going to be a give and take. And until we figure out the best versions of this, till this stuff competes against itself and figures out what's best, we don't really know. So obviously use it with your own caution here. If we look at balancer transaction counts, they have kind of been wildly all over the place, but are definitely sitting at all-time lows effectively, which is not bullish. Average transaction counts rising as average transaction values rising as transaction counts falling, likely because of ETH fees. Even at 80 to 100 gas in fees, it is just too high for most people to want to actively participate in this stuff on a daily basis. It's much easier to do this through bridging, to do it through layer 2. So until we see that mentality shift, the security models be proven, it's hard to think this on-chain activity for any of this DeFi stuff is going to pick up in a big way. Active addresses also effectively all-time lows. NVT all-time highs, not bullish, right? NVT is a measure of it, economic utility relative to price on the inverse. So if this is rising, it's actually bearish. It's falling, it's bullish. MVRV is another one, and the fill here versus price in the line graph. And for most coins, an MVRV of 2 or greater has been the top. For this DeFi stuff, it's kind of all over the place. It's a little too early to know if MVRV is even a signal on backtesting. Previously, MVRV reached 2, then it reached 1. Price kept going a lot. Price went from 40 to 65 as MVRV was falling from 1.2 to 0.95. So not really a signal there in my mind. But currently MVRV is 0.7. And it looks like the low for MVRV is basically 0.5, 0.48. So if MVRV gets down there, I'm confident enough to say, yeah, this is probably more of a buy signal. But as far as sell signals at the top, it's hard to say based on backtesting. And if we look at protocol revenue, Balancer is in the mix here, a tiny slice on the supply side of things at 13 million. I mean, barely registers relative to Uni on a 30-day sample. Uni, Aave, Sushi, Comp, they get most of the supply side revenue on any given month. That could change if the competition adopts layer 2 quickly, adopts bridging quickly. Uni probably never goes anything other than ETH. So stuff like Sushi has a chance to outcompete them by going multi-chain. If multi-chain is the winner at the end of the day, right? Lots of variables here. And if we look at the PE ratio, which is market cap versus annualized revenue, Balancer's in the middle here. And in general, you want to focus investments, not investment advice, but you want to focus trading on stuff that's on the left side of this curve. It says it's more undervalued relative to stuff on the right side of this that's more overvalued. So Synthetics, Maker, Curve, Bancor have a 25x multiple of market cap versus revenue, whereas Aave, Sushi, Comp have less than 5 or thereabouts market cap versus revenue. Flipping gears to technicals, 5200 cross here, volume, RSI, VPVR, monthly pivots. So everything has looked extremely terrible over the past couple days here as we've swiftly sold off on the 19th on a bunch of stuff. Evergrande being a prime catalyst target. I don't know if it was necessarily the catalyst, but between that and Delta COVID stuff rising its ugly head again, VIX way up, On legacy markets, a lot of risk off is happening, and DeFi is definitely not in the risk off category. It is definitely a risk on vehicle, risk on risk on risk. So that's probably what you're seeing here. You know, if there's legacy people trading DeFi or trading metals, people trading DeFi or hedge funds trading DeFi, the first thing they will cut for capital requirements is non-legacy stuff. They're going to cut DeFi first. They're going to cut BTC and ETH. We saw a lot of that in March 2020 as well. Not that that's an excuse for bearish price action, but I think it helps explain what's going on here. Currently have a bearish 5200 cross. We had been looking decently okay for a bullish cross, revisiting these highs. I do like, though, that we are filling in this range between 15 and 30. So that next time, if we do get above 30, we're not going to just dump straight there from 60 to 15, right? There's going to be some support resist levels likely between 15 and 60, 15 and 70 in the future with all this price action. I like that this isn't just Mega Moon. It's having to earn its stripes, pay its dues for being here, right? Some of these tokens like Wi-Fi, where it just went from 0 to infinity for really no reason, I think are the most at risk for just continuous all-time lows over time. Stuff like Balancer, to me, has a decent use case. That's partly why we're holding it in Enzyme. In the DeFi portfolio, it's a protocol revenue. There's yield that can be generated there. But trend-wise, this doesn't look great. The next support down is probably what I have highlighted here at 17. It broke below the monthly pivot. The next monthly pivot down is 13 to 15, VPVR 13 to 15. You don't want to see this get revisited and tested again. That's never bullish to hope for a retest of support like that, in my mind, because it usually means it breaks through it, right? Like if this is bearish enough to get there a third time, it's probably going to break through. So trend-wise, it doesn't look good there. It doesn't look good on the cloud either. It's below the daily cloud. And I wouldn't be bullish on this again based on trend until 27.5 into mid-October. 12-hour cloud also told you a few candles ago as this broke down that things were looking rough. It had a decent rise up and just multiple retraces to lose all those gains that it's made over the past couple months. So you would need this again above 27 on the 12-hour in the near term to be bullish again. BAL BTC, I don't even know what to think of this. It's definitely more bearish than bullish. It's reaching for all-time lows, honestly. Like, it does not look good against BTC, and the 5200, although being spread apart pretty wide here, it looks like it just reconsolidated at the 50. So this could have significant momentum for all-time lows against BTC. All the volume is above price at this point, so there's really no support on any lows here. What I would be watching for is a multi-month, similar to this, a multi-month bull div. November, January here, you had a pretty big bull div form, and I'd watch for that going into Q4, especially if the majors move first. And we've seen this time and time again with rotations. The majors, the high market cap coins will move ahead of altcoins, and then altcoins will have a run as people rotate out of majors and they get relatively expensive compared to altcoins like BAL or whatever. And then you'll get a move off of BAL, but that won't happen until late Q4, most likely, against BTC. And against ETH, it is at an all-time low. It is below the 50. It's below all the volume stuff. No bull div just yet, but the same logic applies here. If the majors are bullish in Q4, everything will be bullish on the USD pair. But against the relative pairs, the alts will likely move late in the quarter as BTC and ETH get expensive relative to BAL. Now, all this, of course, is predicated upon the SEC in the US not clamping down heavily on DeFi stuff anytime soon. Because if that happens, that's going to create a massive upheaval in a very short amount of time for people registering, KYC, AML, all sorts of who knows what as far as regulatory stuff that could be coming DeFi's way here. Certainly wouldn't be bullish. Last I'll just mention the ETH BTC fund and DeFi portfolio. I trade for Techme Capital on Enzyme.finance, a non-custodial portfolio management tool where you can send ETH or USDC or just watch what I'm doing. You can see everything, including AUM, performance, allocation. You can see we have BAL in here somewhere, I believe. Where is it? Here it is. No, it is being yielded. I thought it was. Yeah, there it is. 8% on Aave. and I get various yields on Aave, Yearn, Compound for this stuff. You can also see the trades and the trades tab down below. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.